Welcome back, everybody. Then now we're looking at recognition and measurement, which is in the conceptual framework. Now, recognition, all that means is when do we bring it in? When do we bring it in to the accounts? Okay, when do we put it into the accounts? Okay, now there's three criteria. But before we go on to that criteria, I just want to write down the elements. Okay, so in the accounts there are assets, aren't there? Liabilities, equity, income, and expenses. Okay, now when can we bring any of those elements into the accounts? Well, you can bring them in when it meets the definition. Okay, so we'll have a look at the definition of an asset, the definition of a liability, the definition of equity, etc. later. But before we bring it into the accounts, it must meet the definition of one of those elements. Also, it must be probable. So if it's an asset, it must probably going to bring us in money, or if it's a liability, there must be a probable outflow. And finally, you should be able to put on a reliable measure of the asset, liability, income or expense. Okay, so three criteria, remember them well. To bring something into the accounts, it must meet the definition of where it's going in the accounts. It must be probable in terms of bringing in or money going out, and you must also be able to put a reliable measure on it.